Aloha, and welcome to the Sylvan Bell Business Growth and Exit Strategy Podcast, your guide to building companies that command maximum multiples. I'm Sylvan Bell, author of 5 books on business strategy and sales, creator of the Sell Framework, Scale Framework, and Driver Test. I work with owners of $10 million to $250 million companies, whether you're scaling for growth or positioning for a profitable exit. Each episode breaks down one framework, strategy, or concept you can apply this week to grow revenue systematically, scale operations, and maximize enterprise value. Let's get started. Welcome to episode number 34, the Sell Framework, how revenue quality. Welcome to episode number 34, the Sell Framework, how revenue quality drives your multiple in the exit 360 ratio. And SELL stands for sales process documentation, effective metrics, lead generation diversity, and loyalty from clients. What you're going to find is most mid-market owners celebrate their best revenue year ever without asking a very important question that determines their multiple when they go to sell or can help with their profitability. And the question comes down to this: is any of this money coming back next year? And if so, how much is coming back and what is the quality? This is a super important question. Revenue quality isn't how much you make, it's how much of what you make a buyer can count on 12 months from now. That's why a TTM comes in so important. And people are looking at the history of the company. They're like, what are we going to buy? What are we going to get? How is it going to treat us? And what you're going to find is the Sell Framework is a 40-point measurement of the difference between the revenue that commands a premium and the revenue that gets treated like a lottery ticket. You want certainty. You want your investor, you want your buyer, you want your private equity group to come in, take a look at the organization and say, we're certain that this is going to happen again. This is where you command the maximum multiple. It's the quality of the revenue. It's the quality of the organization. There's a lot that goes into this. But when somebody says, hey, I'm buying money into the future, what they're really asking is, how quality is it? Is it going to be there? Is it going to be there repeatedly? And what do we have to worry about to make this happen? And a good score here can mean the difference between a multiple or a few multiples, just depending upon the type of organization, the industry, and the service. I wish I could say guaranteed, but I can't, because these multiples move on any given quarter or any given year, and you have to be aware of that. Buyers don't look at your top line and get excited. They look at it and they dissect it. And they come in and say, hey, this revenue is going to come into buckets. You know, we want to know what's under contract, what's reoccurring, and what's repeat but not contracted, and what's one time. Where is the diversification, and how certain can we be that this money is going to be here when we buy your company? And then they take that, they put it into a ratio, they put it into a model, and then they build their value off of it. And then they score it. And they're going to say, hey, based upon our dynamic scoring, here's our predictability scale. Here's our predictability ratio. Everything that you're taking a look at when it comes to selling your business is going to come down to mathematical formulas based upon certainty. And that's why I have the name the exit ratio, because it is going to be a ratio that's brought to you. They don't want hopes and dreams. They want certainty. And if they put all of this revenue that's coming in into piles under certain and uncertain, and the uncertain is bigger than the certain, you know you've got problems. You know you've got issues. They want to count on the revenue that's coming in, and that's really going to matter to the organization. Like when I say super importante, it really is super importante. I want to give you some clues to where some problems hide, and the revenue growth trap is where most common blind spots occur. You know, you grew like 40% last year, and the profit line just looks freaking incredible. But nobody's asking if that growth was structural or accidental. Did it happen because of planning, or was it just a one-off situation? And then 3 large project-based deals that won't repeat tear down and bring down your revenue score. And you know, you're in there and you're celebrating some top-line revenue, but what you're not taking a look at is, where did this volume come from? Who brought it in? Is it sustainable? Is it profitable? And is it going to do anything? Like, you could really be running fast in your mind, but standing still. And what's going to come down to is contract fragility. You know, fragility is one of those things where you're taking a look at it and you're like, how often is this going to occur? And can we make it happen again? And if somebody comes into your marketplace and takes your client, what's the risk of that happening? Like that fragility becomes a multiple against you, and it's not a good place to be in. What makes it worse is when these are like handshake deals or something that's not set in stone where somebody can come back and undo it or undo the agreement and walk away. You want contracts locked in where possible. When you meet with a buyer, potential buyer, private equity, Excel Eddie's going to rebuild this revenue like one of the first weeks when he gets your files. He's going to look at contracts, terms, margin, revenue, and the analysis these days because of AI can literally be done in a day. It used to take a couple of weeks or a couple of months, but they're gonna go back and they're gonna build their version of a pitch deck against you. It's going to be their thesis against yours. And if you can back up your information, if you can prove your history, if you can have these conversations, you're reducing your downside scenario. Like you're looking for what doesn't repeat. You're looking for what doesn't stick. You're looking for what doesn't fit inside of the organization. And I will share with you, there are salespeople that hide inside of your organization and do deals that on the back end may come back to haunt you, may come back to hurt you because they're not a structured deal. On the front side, it looks like fantastic. It looks like, yeah, we got revenue. Fantastic, we got revenue. And everybody runs around in circles, banging on pots and pans or whatever you do in your office. And then when you take a look at it, you pop under the hood and you're like, there's no profitability in this deal. Right? It's a skinny deal. There's nothing really for us to have. Yeah, we put the teams in place and we got some action to happen, but at the end of the day, it's skinny. And those deals become a risk to the buyer because now they're like, what's the quality of the revenue? What's the quality of profitability on these deals? For Excel Eddie, when margins are declining despite the revenue growth, they see a business that's buying volume at the expense of profitability. You don't want that. You want Excel Eddie to be stoked, psyched, happy. I'm using some surf language for you today about the deal and about the prospects of the deal. What you don't want is to be recategorized from, cash out on the deal to earn out on the deal. Revenue quality is one of the single biggest levers when it comes to your multiple. When you start stacking how much revenue you have against EBITDA and saying how much of it's going to stick or how much of it's going to be around after you leave, you can get a bigger multiple depending upon your industry, depending upon your service, and how you negotiate the terms. You can have two companies that look the same, but like when you take a look and say like, what is the quality score of both these companies? One may get a better multiple than the other, and it can compound. Realistically, it can mean the difference between vacationing in Europe and buying a place in Europe, if that's really what you want to do. I'd rather buy a house on the beach. That's just me though. And it's your money, so you should score the revenue quality of it, and you should absolutely take a look at it and determine how much of it you're going to keep into the future. And message from your sponsor, Sylvan Bell. That's me. If you're getting value from this episode, here's how to go deeper. First, subscribe to my weekly newsletter, The Party, at scottsylvanbell.com. That's where I share the strategies, frameworks, and case studies I don't release anywhere else. You'll get one actionable insight every week you can implement inside your business immediately. Second, while you're on the site, download the complete Cell Framework, Scale Framework, and Drivers Test, all free with scoring guides, worksheets, and step-by-step implementation checklist. These are the same frameworks I use with $10 million to $250 million companies to build systematic revenue, scale operations, and maximize enterprise value. Go to scottsylvanbell.com right now, subscribe to the newsletter, grab the frameworks, and let's keep building companies that command maximum multiples. Let's get going. There's a secondary consequence to the quality of this deal, and price it. It's just the beginning. Like dings turn into dents, and you don't want that. But what happens is all the risk is placed on you based upon earnouts, based upon deal scenario, based upon how they're going to structure the deal, holdbacks, everything. Like that's not really an exit. A maximum multiple exit is where you get the money in hand and you're able to walk away, and it's not dressed up as a deal. It's dressed up as your exit. So a deal that was supposed to be freedom for you becomes a 2-year performance review with your new boss holding your scorecard, and it was your number 2. It was the person that you brought in to run the business. That's a bad position for you to be in. I'm going to let you know. I've been around enough deals that when a founder, an owner, a president, a CEO, whatever term you want to use, wants to leave, Their mind goes into different places. They don't want to be in the office. They don't want to be in the building. And I've had this conversation multiple times. Hey, Scott, I wish I would have known what these holdbacks would have meant for me, because I'm not in this anymore. I would rather be at the golf club. I would rather be working on fishing. I would rather be hanging out with the grandkids. I don't want to come back to this office. Your role and responsibility is to engineer a magnificent multiple on your exit so that you're not stuck, so that you're not chained to the company, to the organization, that you're not having to go back to, unless you want to. Don't get me wrong, there's people who are want to go back because that's what they're excited to do. They're excited to see the changes that are made, to see the difference, to say like, hey, what could have I done differently? Don't get me wrong, there's people who do that, but that's 2 out of 10. 8 out of 10 is like, I wish I didn't have to be here. Excel Eddy builds prediction models, and what you're going to find, they're based on predictable cash flow. Performing platform companies, they need it for their investors. Private equity groups need it for their debt covenants. Strategic acquirers need it for their integration planning. And when your revenue quality is low, those buyers don't negotiate. They just move on to the next target. They take you from an A-level deal to a B-level deal and maybe to a C-level deal. And then what they do is they'll say, hey, here is our offer. And they give you a take it or leave it offer. And take it or leave it offers can be tough for you if you were expecting a specific multiple to get out and you were hoping for a retirement, because then your plans change. If you were sitting there and like, hey, 10 million is my magic number because after taxes and depending upon structure, I could walk away with 7 million and that's going to hold me for the rest of my life. And I'll be good with that based upon all the holdings that I have now. But if they recalculate out and now you're like, okay, I was hoping to walk away with 7 and now I'm at 5, that changes your dynamics. That changes the direction that you're going to go, because that may be everything you have for retirement. And then what happens is your buyer pool shrinks. You want to be the deal that everybody wants. You want to be like, oh my goodness, I can't believe they got that company. I tried, I couldn't get them. And you want the power imbalance to flow to you. You want the buyer's opportunities for you to be high and to be the one that everybody wants to purchase. And then if you don't have that competition between companies and organizations, you're going to leave money on the table. It's the hard truth. It is what it is. So you're like, hey, Scott, how do I fix this? Well, here's what you're going to do. You're going to build a revenue quality dashboard that classifies the money that's coming in into 4 buckets: reoccurring contracted, reoccurring uncontracted, repeat-based projects, and one time. So I'm going to give those to you again. Reoccurring contracted, reoccurring uncontracted, repeat-based, and one time. And update it monthly. Know your percentages cold, inside and outside, because the build matters. It's a conversion pipeline. It's a deliberate move to prove your revenue into buckets and move from lower quality scores into higher quality scores. Now, I like to talk about this a lot. Private equity company, private investor, buyer groups are coming in and they're buying your history. And if you can show over 3 years, 2 years, hey, look, we've done everything we can to improve our revenue quality. That's something that they get psyched or stoked about, because for them, that's something that they can take to their investment team. You're creating a seller thesis, and the seller thesis works to your advantage. And then you start asking the questions when you're taking a look at the buckets, and you start saying, hey, can project-based clients be shift to retainer agreements? Can repeat clients be moved on to annual contracts? Can one-time engagements be restructured into subscription or maintenance models? And then all those percentage points work to your favor. They work to your capability of saying, hey, here's what we have to sell. Here's the fruit we're putting on the table on the stand that we want people to buy from. The dashboard's going to track where you are, and the conversion pipeline moves you along. You're going to want to work with your sales team and start explaining what targets are, not just like, hey, we need to hit 12 million for this year, but we need to hit 12 million with 55% of that being in contracted revenue that's reoccurring. And you may want to talk to an HR attorney, because I'm not one, and figure out how to restructure the compensation plan so that you pay differently based upon what type of contract is being sold. Now, once again, I'm not specifically in your business, so this is an idea to take a look at. You don't have to do it. But if you're going to get paid out into the future 2, 3, 4, 5 years out, Why not prepare for this now and change your comp plan? And change the comp plan to your benefit, and then induce the greed gland of your salespeople so that they're selling the contracts in the future that's going to get you paid the most. It's just a little bit of restructuring. It takes a little bit of thought. And once again, I'm not a doctor, attorney, marriage counselor, or therapist. I am a taco enthusiast. But the contract conversion now is the thing in the future where you're going to sit down with private equity, private group investor, or investor, and they're going to say, hey, tell me about the quality of what's going on with your sales. And you're going to say, hey, the good thing is 3 years ago, the good thing is 4 years ago, we moved and we changed all of our compensation plans to really push towards longer contracts. And we compensate better for the sales team. And they're going to go, yes, this sounds fantastic, because it's proof. Now you have a seller's thesis that they can go sell to the rest of the team and say, hey, with certainty, here's the numbers that we can hit. You're also going to want to add documentation about the clients so that if this information goes into a data room, it's easy to understand for the buyer, that they take a look at it and they're like, oh, okay, client A, B, and C, they're very similar. Here's their profile. Here's what's done. Here's the amount of revenue that comes in on their contract. Here's the amount of profitability that comes from them. Here's the length, the renewal date, the margin, the lifetime value. And then you're going to want to document your margin by revenue type. Show the reoccurring revenue carries better margins than project work. Where true. Like if this isn't true, don't make it up. But what's documented is transferable. A quality revenue file with classifications, contracts, margins, and client lifetime value by segment is the single most powerful document in your data room. And if you don't know what a data room is, like, hey, Scott, I've never heard this term. Think of it as like a fancy Dropbox, or think of it as a physical location where your data goes. A data room is secure and encrypted. And so if you're uploading sensitive information or proprietary information, a data room is where it goes. But you want it to answer the single biggest questions that you're going to face from a potential buyer or potential private equity or potential team. You want it to be like, hey, we've thought of this. And the benefit of listening to an episode like this is you're being taught to think into the future. There's all the things that you're taught in business school to pay attention to. I know, because I went to business school. It doesn't necessarily give me an edge up. What would give me an edge would have known this information 20 years ago. Build your history. Build your history. And just a little bit more on this evidence. You're going to track these 4 things. Reoccurring and contracted revenue as a percentage of total, measured quarterly on a trailing 12-month basis. The trend line matters. The current number, average contract duration in months. How long is somebody a client of yours? The longer, the better. The duration should be up, and it should be trending up. Gross margin by revenue category. Prove the quality premium in your own numbers. Client retention rate, not client count, but dollars. What's the percentage of last year's revenue that came from existing clients? And show them year over year. Remember, buyers, they don't pay for intent. They pay for proof. They pay for your history. You don't want to make this up. You absolutely don't want to make this up, because you will get punished in court. Those 4 numbers tell a buyer whether your revenue is an asset or a question mark. You want it to be an asset. You want it to be like, hey, this is the grade A type of company that we want to acquire. So, hey, Scott, what do I do from here? How do I make this work? Well, you're going to create a self-test. You're going to open your accounting software and pull revenue by client for the trailing 12 months where possible. Sort it. Flag every deal that's got a signed contract behind it, or if it's going to expire. Flag every dollar that reoccurs without a contract. You're looking for the gaps. You're looking for, like, how much contract do we have versus how much non-contract do we have, and then figure out what comes back to you. You know, and if you're losing, like, this is the thing nobody talks about. Like, if you're losing clients and you've got churn, what's causing it? Is it bad service? Is it bad product? Were they overpromised in the sales process? I was a sales manager, and I had 22 salespeople underneath me. And some of the worst salespeople were the discounters, because they would always overpromise and they would always over discount to get the deal. And so they would set the wild expectations for the buyer. And most of the cleanup was on a specific group of people. So if you're having cancellations and you're having churn, whatever word you want to use, one of the things you could do is track churn by rep. and then track churn by what was charged. Like you may find there may be correlation for you for what was charged and how much was discounted, and then what was actually sold. And then it gives you an opportunity to grade your salespeople. One of the things that's not talked about often enough is the grading of your salespeople can also go into the future, because when you're having the conversation of like, well, how good is the quality of your earnings and your revenue, you can tie it back and say, well, I've got quality salespeople and we train them. The key here is you can't hope that they get trained. You can't. Like there's got to be a process that they're going through on a consistent basis, at least once a week. And you're like, hey, Scott, these people are adults. Yeah, they are. But I can't think of a professional sport or a strategy out there where top performers are not working with some sort of coach to get trainers. In the professional world, that's one of the things that gets done. And for whatever reason, people don't want to talk about it. But I have this belief that it's my role and responsibility to tell you what you need to know and not hide things from you. Like where possible, you want to have your sales team coached by the best at least once a week, preferably 3, 4, 5 times a week, that people are coming in and having conversations and they're getting some sort of workout. Because here's the thing, once they get off target, it's really easy to float and get really off target. The sell score is sitting between you and the multiple you believe and think you deserve. Like this is your thesis. I have roles and responsibilities. You have roles and responsibilities. One of your roles and responsibilities is to get the maximum multiple for your business. So pick one of the areas this quarter and look for uncontracted client relationships and see if you can turn them into formal agreements. You might offer a bounty to your sales team. You might offer them, hey, listen, if you can get them converted, here's what we're going to do. And then like this might be a good way to start changing your pay plan, is to go in and say, hey, we've got all these people who are not under contract. If you get them under contract, we'll give you a spiff. And then the next quarter you go, great, we got all these people under contract and now we're going to change our pay plan. Now, once again, it's a possibility. You don't have to. Depending upon the state, the jurisdiction, the city that you live in, you may want to consult an HR attorney that really specializes in comp plans, because I live in California. They can be quite difficult to deal with. You want to start moving revenue from lower quality buckets to higher quality ones and track the percentage as you shift monthly. Your sales score improves conversion one at a time. And every point up shows in your multiple when you go to sell, or if you decide to hold on to your business, it just makes you that much more profitable. You want to take this seriously and say, hey, what are the opportunities inside of my sales score to move up so that I end up with the maximum multiple? Mahalo for listening to the Scott Sylvan Bell Business Growth and Exit Strategy podcast. Here's what's available to you right now. First, subscribe to this podcast so you get every framework we release. Second, visit scottsylvanbell.com to access the Sell Framework, Scale Framework, and Driver Test. All free with complete scoring guides and implementation worksheets. Third, subscribe to my weekly newsletter, The Party, where I break down strategies and frameworks you won't find anywhere else with one actionable insight every week. Go to scottsylvanbell.com and enter your email. And if this episode added value, share it with another business owner building a $10 million to $250 million company. Until next time, keep building companies that command maximum multiples. Aloha.